Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, February the 11th, 2026. Of course, today we have non-farm payrolls, which is going to be important just to see where the US labor market seems to be. But a couple of quick things. We had quite a lot of data yesterday. We had the National Federation of Independent Businesses survey, which was a little bit on the weak side. So those smaller businesses saying that, jobs were less plentiful and a little less confidence. We also had retail sales, which were flat. They had been expected to rise, 0.3, 0.4, but they came in a little bit soft. So two soft data points. We also had the employment cost index, which rose less than expected, and actually was at the lowest rate since the third quarter of 2021. So that's like, what, 4 or 5 years ago. So the point is here, it looks as though the employment situation is softening. And remember, we had soft or weakish JOLTS numbers earlier on. So the point is that it does look as though the employment situation, the labor market in the US is softening a little bit. Excuse me. It also seems that in terms of inflation, there's definitely less pressure from employees on the employers. So it looks as though that the kind of the balance of power is moving a little bit more towards sort of companies and employers, and therefore that looks like it's a slightly sort of deflationary kind of situation there. So the point is that the market is looking at everything as though the labor market is weakening a little bit. And does this mean that the Fed could be cutting more? And in terms of what we're getting today, let's look a little quickly what's expected here. So the consensus number is around about 70,000, but the Bloomberg Whisper number has gone down to about 37,000. It's gone down a little bit. And that's just because Kevin Hassett, a few days ago in an interview, he essentially said that they're expecting sort of slightly weaker numbers and no one should panic, but sort of a wink, wink, nudge, nudge to the market that these numbers this morning could come in a little bit weaker. So the market, I think, probably realistically is expecting maybe not 70,000, but maybe something more like 40 or 50,000, something like that. So that's going to be an interesting one to look at. What we're going to get as well, of course, is a huge amount of sort of revisions. Now, I'm not going to go into all the details. It's quite complex. We're going to get from the so-called sort of birth-death model of new businesses. Apparently, there's a lot of distortions. There's going to be a new methodology being introduced by the Bureau of Labor Statistics. The point is that that sort of period from 2024, sort of April 2024 until March 25, that's going to be revised. And then also from March 25 until December 25 is going to be revised as well, incorporating sort of new data. Point being is that there's going to be sort of a big number coming across the wires. The consensus is, something around about, I've got it here. Where's the consensus? Around about 825,000. So negative 825,000 jobs being produced in that period, 24, 25. And you could say, why is that going to happen? It's just because a lot of this stuff is all statistically sort of rearranged and adjusted. And the idea is that the Bureau of Labor Statistics, they think, were maybe overstating job creation statistically by 40, 50,000 per month. Now, keep in mind that Powell himself, Jerome Powell, at a couple of his press conferences, I think like two press conferences ago, said something like, oh, anyway, there's probably 60,000 jobs per month, which have been overestimated, so too optimistic. So even Powell himself is essentially discounting 60,000 jobs a month. So the question is that the market is expecting that. So we don't need to sort of panic and freak out this morning if we get a number saying, oh, minus 7 or 800,000 jobs in that 2024, 2025 period. What will get the market's attention, I think, is something more than, let's say, 850, 900,000 jobs. And symbolically, if we get something more than, let's say, 1 million jobs being deducted from the last sort of 18 months sort of payrolls, that's going to send a little bit of a shock through the market. So the question is, we have to be a little bit careful here because the numbers are going to be a little bit complex, the revisions. And of course, on Twitter and on the internet, there's going to be all kinds of pundits sort of weighing in immediately, saying it's good, it's bad, it's expected, it's higher than expected, it's lower than expected. Personally, I think it makes sense to look at a couple of things. I'm going to be looking obviously at the headline number, But I think also it's going to be important for a couple of things. It's going to be the average hourly earnings month over month. Expected was 0 0.3, expected to come in at 0 0.3. Just in terms of the Fed's inflation mandate, we had the employment cost index, as I mentioned, came in yesterday a little lower than expected. It's going to be interesting to me to see if the average hourly earnings stays at 0 0.3 or maybe even ticks down to 0 0.2. Why is that interesting? That's important because a lower average hourly earnings does indicate that the employees, workers' power is waning somewhat. And that would indicate probably a softening job market. Let's just put it that way. Secondly, I'm going to be looking at the non-farm private payroll. So let's forget the government. We know that manufacturing is a little bit weak. We know the government, is who knows with Doge and whatnot. But I personally think an interesting one's going to be the private payrolls, which consensus 70,000. Let's just to see what happens there, because I think that's probably going to be the one which is going to give us a sense of, what is actually happening in the labor market. Now, keep in mind that recently we had, as I said, we had JOLTS, which was a bit weaker. We had ADP yesterday, which was a bit weak. ISM manufacturing was not great. So ISM services was okay. So I think there's a general sense that the labor market is kind of softening, slowing down. But of course, on the other hand, we had this whole demographic thing that there are definitely sort of less immigrants coming in, documented and undocumented, into the US. So there's some sort of sense that the labor market is kind of in balance in a sort of a weakish kind of way. Although having said that, I did read some research 3 or 4 days ago, some quite detailed research, which essentially questioned this whole idea of labor market imbalance and essentially saying that the pool of new workers actually was a lot higher than the sort of the narrative, and therefore the labor market technically was probably a little bit weaker. Anyway, so the point is here, let's keep an eye on all of that. The other super important thing, of course, is just going to be the unemployment rate, which, of course, is a different survey. That's the household survey, so it's a different survey from the other one. So remember, there's two different surveys. So the unemployment rate previous came in at 4.4. That's probably the key thing. And we know that Jerome Powell, although he's a bit of a lame duck, as we know, Kevin Walsh is coming in, but we know that Jerome Powell focuses on that. And I think the market's going to be very focused on that. If that were to go to 4.5 or 4.6, that would definitely get the market's attention. Obviously, anything lower would be considered a positive. So that's sort of the whole sort of situation there. Now, just in terms of where we are with the Fed, we know that the market is pricing in a couple of cuts for later in the year. But really what's going to be sort of importance today is, especially after the comments of Kevin Hassett, a couple of days ago saying, oh, employment could be a little bit weaker. And we know that there's the new Fed chair, Kevin Walsh, enormous political pressure by Trump. The question is, will the Fed actually be forced to cut a little bit more because of a weakening labor market? So let's just see what's priced in at the moment. Obviously, for the March meeting, which we have here, 80% saying unchanged. So that's going to be difficult for that to change a lot. But what really could change is, let's say, the April meeting. You see already the market in terms of the Fed funds futures is already pricing in, let's call it a 1/3, a 36% chance of a cut in April. So if we were to get sort of substantially weaker unemployment rate today, lower average hourly earnings, and of course maybe these revisions plus or more than minus 1 million, this number here could go up, and that's going to put that would be obviously a buy in the SOFR futures. The 3 months futures, maybe sort of the March or the June ones would be a good for that, and obviously the 2-year, the ZT, something like that. So that's going to be an interesting one to watch. And if we just look at the probabilities here, again, as you can see here, at the moment, this is where we are between 350 and 375 basis points. No real change expected, no cut, still just at 21% for the March meeting. But as I was just pointing out, it really could be more in this April or June meetings where we start to, well, June, it's almost like a cut priced in. But that could work as well. Now, of course, if we get a hot number, that's going to be the opposite of that. So yeah, so let's just look at a few different charts and whatnot. I'm going to look at some, let me just move something here on my screen. So let's look at sort of the bonds. What is interesting, if we look at the bond yields, let's look at, let's say, the 2-year yield. You can see here that the 2-year yield is that at the lowest end, a low end of its range. Like if you look going back even 5 or 6 months back to sort of October here, you can see that the 2-year yield is currently trading at about 3.45. So we have the effective Fed funds rate is at 3.64. So let's do some maths. 45, 55, 65. So that's essentially their sort of 20 basis points. That's only 20, that's 20 basis points lower in 2 years out kind of thing. So that's at quite a low sort of point. And I think that's almost a little bit, sort of, I don't want to say it's too low, but definitely, if we do get sort of a softer number today, could that come in and break, let's say three, down here, 3.42, something like that. It could break down low, but I don't know that unless we get an insanely low number, um, this should go down too much more. So it wouldn't surprise me on a low number whether the ZT, for example, so the 2-year futures go up, so therefore pushing down the yield, which is what we're looking here for. If that breaks to 3.42, maybe break a bunch of stops. There could be some stops here, but then I think that probably will be around about enough there. On the other hand, what is interesting is that we have the let's say the 30-year yield that had a huge down day yesterday, and you can also see that that's at a pretty key level. So we had a sort of a flattening yesterday, basically based on this idea that the labor market is weakening, and the general economy seems to be doing okay, but we did have that flattening yesterday. And again, was this sort of front running the Kevin Hassett comments? Maybe we'll see. But if we get a weak number today, again, we could get a little bit more sort of a flattening of the curve as those yields go down. The other thing which is going to be interesting to look at is just in terms of the US dollar, it's going to be the differentials. That's something I'm keeping an eye on. So what we have here is the US 2-year yield subtract the German 2-year yield. And what is interesting is that this differential, which if we go all the way back May of 25, was at about 220 basis points. And as you can see here, that's come in, that's sort of closed out. So that basically means the US 2-year yield has got a lot closer to the German 2-year yield. So that's a combination of the German 2-year yield going a bit higher and the US 2-year yield coming in a lot. And you can see here we're only now at about 1.4%, 140 basis points. Now, if we get weak data today, what is weak data? I would say, consensus is 70,000. Bloomberg Whisper number, is about 38, 40,000. So weak data to me means something like, 20, 30, 10,000, obviously a negative. That could come in a little bit. This differential could actually narrow even further, which means the US yields coming down. And, in theory, that's going to weaken the US dollar and would strengthen the euro. So that's something to look at, is this differential. If we also look at, let's say, the 10-year, you can also see that that's at a pretty key point, but that's also coming in. So let's see if these differentials continue to narrow. Everything being equal, that should be a negative for the US dollar. Okay, so let's look at a few other sort of charts and just see what else is going on. If we look at volatility, just want to keep an eye on vol. Vol creeping up a little bit. It's come off the highest levels. It was up into the 20s a few days ago. So volatility, it's not at its lowest levels. It's certainly not at 13 or 14 or 15 or up at 18. So that we have a bit of premium, a volatility premium being priced into the market because obviously we have the non-farm payrolls today, and then we have the CPI on Friday. So any options which are being priced for today and up to the end of day on Friday will have a bit of extra volatility priced in. So 18, a level of 18, is indicating sort of over a 1% sort of move. So that's that there, but volatility, it's not massively high, so that's okay. The other thing as well is that if we look at the move index of bond volatility, that is starting to creep up, just because we had quite a big move, even a positive move yesterday in the bond futures. So let's keep an eye on the move, because keep in mind that in general, equities do not like too much volatility in bonds. Even if the bonds are moving up, it just in general likes a stable bond market. And that has been one-way traffic more or less for the last 6 or 7 months. Less and less volatility in the bond market. But so let's keep an eye on that. It's nothing worrisome at the moment. But if that were to spike higher, that could start to put a little bit of pressure on the equities. Talking about equities, I spoke yesterday quite a lot of length just about all of the different relationships. As you can see yesterday, not a huge amount of energy. Probably waiting for the data today and then the CPI. A similar kind of situation overall in the broad index of the Nasdaq. Quite choppy price action. If we look at the Russell, again, pretty choppy yesterday. So I'm not going to talk too much about that. We have McDonald's today. Interesting in terms of sort of health and also the forecast. What does McDonald's say about, sort of the so-called K-shaped economy? People with lower incomes, how are they going, et cetera, et cetera. What I want to look at quickly is oil. I'm just going to grab some tea here. You can see a big breakout in oil here, and it had been going into sideways consolidation. So it bounced off this 61.8% fib retracement, which also coincided more or less with the that horizontal support. So kind of a sideways consolidation, pushing out. Now, I don't think this is necessarily because the market thinks that there's not enough oil in the world. Um, in fact, I think this is geopolitical in the sense that Trump yesterday, it's very complex to know what's going on with the talks with Iran. Iran clearly seems to basically be saying, hey, we just want to talk about our nuclear enrichment, uranium enrichment program. We don't want to talk about our ballistic missile program, and we don't want to talk about our sort of proxies in the Middle East, sort of various factions, Hamas, the Houthis, et cetera, et cetera. But the Trump administration is pushing the Iranians to do a complete talk, which basically talks about regional security and missiles and all that kind of stuff. So there seems to be a little bit of at loggerheads here, not a huge amount of progress. There's sometimes headlines saying, yeah, things are happening. Other times they're saying it's not happening. And I think this spike here is probably attributable to the headline that Trump yesterday came out and said that he was thinking very strongly of sending a second aircraft carrier, so boosting the already significant military presence in that part of the world, in the Gulf. And so the market is still not at all thinking that everything's all clear, and still signaling that there could be some kind of attack or some sort of risk off kind of situation here, and therefore it's pricing in a higher oil price on the idea that there could be a sort of disruptions to supplies. The other thing as well, just FYI, I was reading yesterday, I don't know if I mentioned this, but I was reading yesterday that there's been a very large buildup of transport planes. I think about 180 of those giant transport planes, just, one or two a day, two, three, four, five a day, going across from the US and Europe into the Gulf state. That would indicate a significant military buildup. I don't have any more information than that. Obviously, I'm not inside the Situation Room. But what I'm trying to say is that there is a large military presence in the Gulf now, US military presence, and there's every day more and more buildup. So I personally think that this has probably justified this risk pricing in oil. It would not surprise me at all if there is some kind of strike. At some point, I don't know, today, in the next minute, in the next week, in the next 2 weeks, who knows, the next month. Trump is definitely emboldened by what happened in Venezuela. And keep in mind that Trump the Trump administration did that massive bunker busting bomb raid on the US, on the Iranian nuclear facilities about, 6 weeks ago, something like that, with no repercussions in terms of blowback. So I think Trump is feeling pretty good about his chances of maybe doing a so-called surgical strike again, and oil is reflecting that. So let's keep an eye on that. Otherwise, I just want to talk about the dollar here. You see the dollar here, pretty weak price action the last few days. As I've been signaling for a few days, it was rejected at the 61.8% fib sort of level here. Obviously, we've got the key level down here at about 96.3, and then if you want, you can measure out some moves a bit further lower. I think it's pretty simple that we're going to get the data. The data is expected weak. So the point I'm trying to make about the US dollar and the bonds, like the 2-year, is that the data on the non-farm payrolls is expected to be quite weak. So in order for the US dollar to further weaken, I think it would have to be significantly weaker than expected. And by the way, that's the same thing for the front end of the curve. We already saw that the 2-year yields are down a lot over the last few days. So I think that would have to get very, very weak data, as I say, a headline number of 10,000, 20,000, negative headline number, revisions of greater than 1 million. So I think it's interesting today. If we get something relatively solid, 40, 50, 60,000, and maybe headline revisions coming in at, sorry, not the headline revisions, the overall revisions coming in at, minus 750,000, 800,000. That's kind of expected by the market. We could get a little short-term bounce in the dollar. Will that bounce be long-lasting? I don't think so, because I think the macro factors, the structural factors are still auguring for a slightly weak US dollar structurally. But let's have a look at that. Same kind of thing for the euro here. We see the euro has shown a little bit of strength, but as you can see at this overhead resistance level at about 119.20, just fading a little bit. By the way, talking about the euro, we have the ECB's Isabel Schnabel speaking today. She's considered the intellectual powerhouse of the ECB, potentially even a successor to Lagarde at some point next year. We shall see. And yeah, let's just see what happens. Again, it's going to be data dependent. Talking about the ECB, the Banque de France, Villeroy, he announced his resignation quite suddenly. He was expected to stay on for another year or so. He's suddenly saying that he's going to resign and leave his post by June. I think this is the ECB. Just on a side point here, this is the ECB. There's been quite a few moves amongst the European power brokers, the European establishment, essentially concerned about sort of right-wing and populist parties taking power and potentially having some kind of pressure on the Bank of France, the Banque de France. And so I think this is Macron probably a behind the scenes deal, sort of saying, hey, we at the Elysee Palace, Macron, we want to appoint who we want as the governor of the Bank of France, and we don't want to wait for sort of one of the right wing, if the right wing government gets in France in the presidential elections next year, to appoint someone who might be more interested in doing QE. Kind of interesting what's going on there. I won't go on too much about that, but the machinations of European power politics, and it definitely seems there's been a lot of sort of appointments and a lot of moves. I think the European establishment, which is pro-integration, anti-Brussels, does not want some of these right-wing populist parties to have sort of too much institutional power, even if they win at the elections. All of the institutional pieces are put in place to protect the status quo. Okay, just looking at a couple of other things quickly. I see the British pound had been under quite a lot of pressure. There was some talk that, Prime Minister Starmer may have been kicked out, but he seems to have consolidated his position. So the pound just having a little bit of a consolidation here, based on the fact that it looks as though there will be continuity in UK politics, and the UK Prime Minister, for the moment at least, will be keeping his position. If we look at the Australian dollar, the Aussie dollar just remains very, very strong. And you see here it had a bit of resistance at about the 69.30 level, but then we had higher than expected inflation. We had the hike by the RBA, and again you see it's pushing up to these new levels. Let's have a look at this level up here. You can see here that this is a pretty key level at around, it's like a triple top at this point at about 71.30. And some of this sort of immediate push was just because sort of Deputy RBA Governor Hauser was out over the overnight, essentially saying that inflation is definitely too high, and that was a problem. So we had the RBA, alerting the markets to the fact that they don't like this high inflation, and who knows, maybe another hike could be on the way. So the Australian dollar doing pretty well there. So let's look at that. Finally, just want to have a quick look at the Japanese yen, which is here. And we can see here the US dollar weakening the last 3 days since the election. So, still sort of weakening. There is a little bit of a trend line here. If I just sort of zoom out here a little bit, you can see this long-term sort of down trend line here, that maybe that'll be some kind of temporary, a little bit of a sort of support here. But basically, the US dollar is sort of weakening, and Takaichi over in Japan, the Prime Minister, she's done a great job of convincing the market that they're not going to sort of issue too many more bonds, and that fiscal responsibility is very much on her agenda. And that she continues to say, I saw yesterday more comments basically saying that she wants to communicate to the markets, she wants to communicate their fiscal responsibility, and that any sort of extra sort of spending could be taken out of the excess FX reserves, and it wouldn't necessarily be extra bond issuance. So, the Japanese yen loving that. Obviously, we have the Nikkei ripping a lot higher as well. So that's all good. Finally, guys, want to have a quick look at our friends, the metals. Let's look at spot gold going higher, possibly also a little geopolitical stuff in Iran. We just mentioned talking about oil here. The gold volatility is going down. It looks as though the gold bulls are going to sort of continue to take this higher at this point. Again, keeping an eye on the 61.8 February trace level, which looks at about $5,140 or so. Once we get above there, I mean, it could be a bit of consolidation there, but if we get above there, it could be going higher. And, I have to say, yep, I'm going to look at silver as well. Silver as well, creeping higher. As I say, as the volatility comes out, consolidation happens, and as the volatility lowers, and that all of the shorts have sort of exited, or hoping to exit, this could now move a little bit higher as well. Just by the way, it's interesting. One of the big players over in China had about 30,000 lots He apparently still is holding some of that, and is technical point here, but is the huge whale over there. And at a certain point, he will have to sort of buy to close his positions because he's not able to roll over in the next contract. Don't want to get into too many details. Point being that at some point there could be a large short squeeze. There could be a short squeeze happening as this whale based in Gibraltar basically buys to close his position, about 30,000 lots. Very interesting article I read yesterday, just detailing that. So that would cause some kind of short squeeze because he's a large part of the market. Interesting. Let's just finally end on our friend BTC. What could I say? More weak price action. I mean, this just doesn't, there's no bids here at this point. I won't say too much about it except to say that the price action remains weak. There's zero sign here of a basing formation. There's simply more distribution and weak price action. So it's too early to buy this, in my humble opinion. Okay, guys, that's it. Let's keep an eye out for the non-farm payroll numbers at 8:30. Okay, have a great day, and I'll be back tomorrow with the macro snapshot. Thank you.